Hey everybody, this week we're going to look at chapters 10 and 11 for Kate's cards, the serial problem that's worked throughout this book. So there's two parts to chapter 10. There's the first section that has to do with Kate's loan, and the second section that has to do with a different situation. So the loan, what's going on with the loan is that Kate has a $75 payment that needs to be made in interest. Now the $75 in interest accrues means that even if she doesn't make any payment, she still has to expense that interest each month. So she's been expensing it, and then it's time for her to make a payment. So she needs to make a payment of the $75 for each month that hasn't been paid. So if we go ahead and look at the template, what you'll see is that you have three lines. So one line is the cash payment. That's the total amount that she's going to pay for the bank. The other two lines, we have the interest payable and the interest expense. So the interest expense is for the current month. You see, an expense can only be in the month in which it's attached to. Since each month there's a $75 interest amount that goes with each month, we have to put interest expense in the month that it occurs. That means that for the current month there's an expense. However, in past months there were payables because we didn't pay the interest. I hope that makes sense. What I'm getting at is that an expense goes with the month, but that doesn't mean that the cash goes with the expense. That's what accrual basis accounting is all about. The second part of the problem has to do with a lawsuit. So supposedly another company is suing Kate, saying that she's stolen one of their designs. And so we need to do a discussion on what the implications of that are regarding accounting. So in this text box here, we need to discuss what the impending lawsuit means to Kate's financial statements. How are lawsuits covered in the financial statements? You don't need to say specifically what number she would put in this area. That's not what this is about. It's about a discussion of the concept of how things like lawsuits and other contingent liabilities are recorded and would be provided for the users of the information in the financial statements. So explain that here. Make sure that you're detailed enough to show that you understand what a contingent liability and a lawsuit are all about. In chapter 11, we're going to look at different types of stock. Stock is basically an investment. What we mean when we talk about stock is that other people are investing their money in the organization. When we talk about an investor will become an owner, and there's a difference between an owner and a lender. There's potential kinds of stock that could be provided if another institution becomes an investor, meaning they buy stock in the company. So the first question is discuss the difference between the two classes of stock. So looking at the template, that's what number one is discuss the different kinds of stock. And number two, Kate has decided that she does not want to give up voting control of Kate's cards. So understanding the differences between the classes of stock will help you understand what kind of class of stock would be more appropriate, since she doesn't want to do that. In part two, she wants to provide preferred stock. Here in the template, what would be the journal entry if we did provide preferred stock? Number three, Kate wants to pay dividends. She's a little confused between cash and stock dividends, so explain the difference. What does that mean when we give a stock dividend? Why would we do that? What benefit does it have to either party? There's a section here for you to discuss that. And it also says you need to discuss the effect of issuing a 10% stock dividend. So then number four, Kate decides to issue a cash dividend on both the common stock and preferred stock. They tell you how many shares are outstanding and what the dividends would be. So then provide the journal entry for the payment of the cash dividends. So here's the area for the journal entry. So in number five, we need to go ahead and do a statement of retained earnings. Retained earnings means profit that we keep. So over the time when the net income, meaning profit, is adding up, sometimes they give that net income back to the owners, the stockholders. They call that a dividend. If they don't give it back as a dividend, then that retained earnings keeps accumulating, adding up over time. And so every period that we do the financial statements, we need to roll it forward. So this is July's stockholders' equity. It shows the retained earnings. We need to roll that retained earnings forward one more month. So we'll need to take that retained earnings and then add to it any new profit and then subtract from it any dividends that we give back in the month of August. So then we can come up with the new retained earnings for August. Make sure you use formulas for these. I want to see that you're doing it using Excel, and I give you a check figure. And then finally we have the stockholders' equity. What would the new stockholders' equity be? So the stockholders' equity is going to include the value of the stocks, preferred, common, whatever, as well as the new amount of retained earnings. So we have the information from the previous month, and we just need to add any new information to roll that equity forward for August. So that should get you through. Make sure you submit this to me on time, and have a nice week.